Everyone, welcome to Dr. Frank's Finance World. I am Dr. Frank, the bank, where I try to teach you something about finance and hopefully you can use it to save or make money in the future. If you like what you see, be sure to subscribe. There's lots and lots of other videos coming, so you might want to hit notifications as well. We try to leave the links in the websites at the end of the video or somewhere in the notes. And check out the books in our drfranks.com, drfranksfinanceworld.com website, because we have a whole list of Amazon books that are pretty cool. Anyway, so the next part of fundamental analysis is actually what I call transforming the numbers. You have to put things in a common size sense so that somebody the size of Walmart can be compared to somebody the size of Macy's. Otherwise, the differential in size will wipe it out and you won't be able to see anything. So we're going to look at these common numbers. How would you compare large, small firms? And then when you scale each firm, this is kind of the cool thing. It doesn't really matter whether it's a balance sheet or an income statement. When you scale it by the common size, it will tell you where each dollar is, what percent of a dollar is spent on an income statement, and how much of the dollars in a balance sheet are in each category there as well. And that helps from a comparison standpoint. And we'll use comparison when we get to valuation stuff. So, anywho, when you're looking here, and you can see we took somebody's income statement and we took it over a number of years. As I've always said, watch which direction it's getting newer to older. It's getting newer as you come to the left. So 2022 is right here. You also, I like to just look at the raw data a little bit. And so one thing you can see from this one is, in 2016 and 2017, it actually got a little smaller. 2018, it got a little bigger, but still not much. And you can see from 2016 to 2019, this specific company grew very, very little over that 4-year period. And it grew a little more in 2020, but as you started to hit COVID, where people were getting a lot of basically free money to go spend, since it's a retailer, you got to see that you got quite a jump in what they were actually selling out there. So you can see that 2021 was quite a bit higher than 2020, certainly a higher growth rate than it had been the last number of years. And 2022 is even higher still. But what you see now is a definite slowing. You can see the growth from 22 to the last trailing 12 months, that's what that stands for, is very little as well. So we're back to the low growth that it was before COVID. Another interesting one to see is you can see that the cost of revenue with 106 billion versus 107.8 billion, 108 billion basically, you had cost of goods sold go from 74.9 up to nearly 80 billion. So you increased revenue a little bit, but your cost of revenue increased dramatically. This is where you start to see the impact of the inflation at the producer prices level kick in. So they had less gross profit. It's interesting still, you can see that the SG&A, sales, general, admin, have kind of grown and kind of grown and kind of grown through the years. But you would hope that as they slow down, it would start to come down as well. It did not. Unusual expenses are just a one-time thing in there. So these are operating expense, and you see their operating income fell quite a bit from last year, and it's more in line with what had been the years before. So if you're going to do a pro forma on this company, you're probably going to look at the growth rates from before and start to line those or align those with what might happen next, because we're going to be predicting out here somewhere in the future. It is from the predictions that we can do valuation. So you can see their interest income has actually gone down somewhat, probably because they have less debt, although not in the last year. And then when you see the income before taxes, ultimately the provision for income taxes, you see that the net income was about 7 billion versus 4.2. When you look at 4.2 as a percent of 107, it's pretty easy to see that they are profiting to the tune of less than 4 cents for each dollar in the future. When we go to the next page, we can actually see when we transformed it, what we have done, and maybe I should go back here, is we take every single category on this page except for total revenue, and we divide it all by total revenue. You do that by putting dollar signs inside the Excel files, so you can go from one to one to one. You can copy it over years. But cost of revenue, for instance, is going to be divided by total revenue. Gross profit is going to be divided by total revenue, and so forth. And when you do that, you'll see kind of interesting. The top line, I actually did new minus old divided by old to see how much it was growing from year to year. And you can see, indeed, we had the down growth. It got smaller in 2017. And then you can see kind of that 3% growth. Look at what the growth rate was for the last couple of years. That points out what happened when people got more government transfer payments. And then you see in the trailing 12 months, however, it has gone back to smaller than it has been in the last 5 or 6 years, and almost to the time of zero to negative from the past. The cost of revenue here at 73.77% is higher by far than any of these others. It's pretty typical when you see a big company that these don't grow a lot. It's a big boat that you're turning around one direction or the other. And one of the things we'll talk about with the cost of revenue when we get to the accounting section is, what is the revenue made up of in the sense of what products are they selling? The more recent products or the services are going to have much, much higher profit margin than the other products out there. So it's just something to consider. Maybe the difference here is what they are selling is, or what, is more a percentage or higher percentage of what is the lower profit stuff. An example for a large retailer, and this is not that company, but for a large retailer, is if they have automotive tires as opposed to t-shirts, as opposed to groceries, you're going to have different gross profit margins on those. And the more of the low profit when they sell, the lower gross profits you will have. You can see SG&A was actually lower. They have done a little bit better job of controlling the costs the last several years. And there's operating expenses, and eventually you have the net income of 3.92%, which is indicative of the kind of crummy years they had back here. So this retailer is unfortunately returning to these times. And so the next question becomes, what are we valuing it at? If we were valuing it at 15 times earnings here, and it's 25 times earnings here, it better get back to where it's making more money, or you're not going to see any increase in price or even a possible price drop on the valuation of the stock going forward. We can do the same thing with the balance sheet. This is the balance sheet as well, and you can see I got it probably from FinViz, because you can see that it's got 7 years worth out here, and I copied it and put it inside of an Excel spreadsheet. But you can see, here's just the cash equivalents. You can look at a lot of times when you put cash and short-term investments together, so you can see they have this higher profitability is definitely added to their cash. They put more of it in short-term investments because they need to make some money off of it. But look at what's happened. The total receivables up a little bit. Look at the inventory, though. This is what's interesting. We already know that revenue increased barely from 2021 into the trailing 12 months, but total inventory has actually ballooned by more than $3 billion. And now you start to see, this is the fall of 22, while they're talking about retailers having issues with too much inventory, and that it would lead to them discounting, and discounting would lead to them having lower profit margins, and that's probably still going to feed forward for another quarter or two out there. So you can also see total current assets and so forth, property, plant, and equipment. They've picked up a couple things out there, buildings and stuff probably. Goodwill is usually a function of buying somebody. They just moved it over. Intangibles just moved from one category to the other, but anyway, other long-term assets is growing slowly. Accounts payable is where they've tried to garner some of the money. When you lock up another $3 billion in inventory, you have to find somewhere to find that money. It's either going to be cash or debt or equity that you issue, or, as can kind of be seen in the case here, accounts payable is money that you owe your vendors, people you're borrowing from. Pretty much they took it out of the hide of the vendors. They are paying the vendors much more slowly than they were before. Accrued expenses is usually employee costs, taxes, that kind of stuff, so haven't paid yet. They had a bunch of long-term debt roll into last year. Hopefully they got it at lower interest rates. But at any rate, you can see long-term debt also climbed by $1.7 billion. And let's hope for them that it was lower interest rates. This kind of movement in the future is going to have a big impact on the income statement, because you got to pay interest on that debt. And so the more that rolls into current debt, and the more you're going to have to finance it going forward from 2022 for the next couple of years, as interest rates remain high, the more impact that's going to have on the income statement. So anyway, the next part of this is we turn this into a percent of total assets, and you can just see where they all kind of fill in. Look at the jump in cash and short term from 6%, 3, 5, 6% to 16%, but they've used up some of it. probably offsetting the extra cost recently. You can see the jump in inventory went from 20%, 21% basically of total assets to 25.8% of total assets. So this starts to tell the same tale that we kind of saw from the raw numbers, but in easier to see numbers and so forth. Anyway, let's go back in here. Then you have, anyway, everything has been turned into, you can see the accounts payable is higher. I just go down here and look for bigger differences in the numbers. And that's where you can basically see it. Total liabilities is now 76% of total assets, where before it was only about 71%. So the combination of payables that they have and the debt is what has driven up these total liabilities for this company. So that's it. In order to transform the numbers to look at the trends, and therefore create a market pro forma. If you go back and see before, we've looked at a little bit of what it means to do a discounted cash flow, but you're going to need a pro forma or future numbers to do that. And the way you do it to get the trend analysis is to turn it into common size. That's how we transform it. So, it's meant to help you look at trends so you can do predictions. This is a great book, by the way. It's one of the first ones I ever read in this area. And it's called, Eric Halford here, Techniques of Financial Analysis. I actually get to talk to him twice, too. He's a really nice guy. He's gone now. But at any rate, the book is very good. I used it at Texas Tech when I taught financial statement analysis there, even though it's a practitioner instead of a textbook. But tells in plain English how it goes. Know where research to look at this. Look for trends in the historical numbers. We will use those trends to predict. So don't forget to send me emails with comments and suggestions. We're working on an Ask Dr. Frank thing going out there in the future, and making pro formas is next. Thanks, you guys. Have a nice day. We'll see you. Bye-bye.